All right, let's jump right into this. We are literally witnessing one of the most aggressive hardware supercycles in tech history right now, and it's completely driven by the massive global build-out of artificial intelligence infrastructure. So welcome to today's Explainer, where we're executing a deep dive forensic audit of SanDisk Corporation's fiscal year 2026 strategy. Now, this analysis is powered entirely by the strategic intelligence team at HDIN Research. I'm your host and market strategist, and I'm joined by our senior financial and semiconductor specialist.
Thanks so much for having me. SanDisk's first full year operating as an independent company after spinning off from Western Digital has been nothing short of historic. And what we're going to do today is basically strip away all the noisy headlines. We want to look directly at the structural mechanics, the hidden balance sheet risks, and the true operational leverage that's buried inside their latest 10K filing.
To start us off, 175.3%. Think about that for a second. That is SanDisk's year-over-year revenue growth, absolutely catapulting them to $20.2 billion in top-line sales. In the semiconductor memory market, you just do not see legacy players scaling at that velocity unless there is a massive structural shift in global demand. So really, SanDisk's 10K has essentially become a bellwether for the health of global tech infrastructure, pretty much proving that hyperscalers are buying up enterprise storage as fast as it can physically be manufactured. So, to make sense of all that explosive growth, here's our roadmap for today. We'll quickly cover the AI storage transformation, do a financial reality check, dive into the Fab JV advantage, map out AI demand and their global footprint, look at some hidden risks on the balance sheet, and then wrap up with the HDIN strategic outlook. Let's get right to it. Section 1. The AI storage transformation. This is all about that critical NAND memory cycle shift. Moving right into Section 2, the financial reality check. Here's where we unpack this AI-driven supply deficit. Now, to really understand these financial numbers, you got to remember the macro narrative we've been tracking. The NAND memory cycle violently shifted from a severe down cycle of oversupply just a couple of years ago straight into a hyperscale AI boom. And when you transition from a historic industry glut to an AI-driven supply deficit, the financial whiplash is incredibly intense.
Exactly. And the sheer scale of this recovery is just wild. We are talking about a dramatic gross margin expansion, going from 30.1% in FY 2025 to a staggering 71.5% in FY 2026.
Right. And if you dig into the footnotes, you'll see this wasn't driven by some miraculous reduction in manufacturing costs. In fact, unit costs only dropped about 2.3%. This margin explosion was almost entirely driven by a 139% surge in average selling prices, or ASPs. Basically, buyers in the data center space were prioritizing securing supply over negotiating on price. Okay, let's talk cash. On paper, SanDisk reported a phenomenal 102.1% cash conversion rate, generating $11.67 billion in operating cash flow. But here's the forensic reality check we need to point out. That cash flow was heavily padded by $2.59 billion in upfront commercial subsidies. So SanDisk uses what they call New Business Model, or NBM contracts. Essentially, AI hyperscalers are literally handing SanDisk billions in upfront cash advances and security deposits just to guarantee future memory shipments. It's an incredible liquidity cushion for sure, but it's really important to recognize that this customer cash is what's actually funding their massive working capital expansion. All right, Section 3, the Fab JV advantage. Let's look under the hood at this shared fab joint venture. So, how exactly is SanDisk physically building all these drives? Competitors like Samsung operate on a pure-play IDM model. That means they have to spend tens of billions to build, own, and equip their own fabrication plants from the ground up. It is highly capital-intensive. But SanDisk uses a capital-light shared fab joint venture model. They partner with Kioxia in Japan to essentially split those massive front-end costs. And understanding the mechanics of this JV is absolutely crucial for investors. Under their agreements, there's a 50-50 fixed cost absorption rule. That means SanDisk has to pay for half the JV's fixed cost, totally regardless of how many wafers they actually end up buying. Now, during a down cycle, that creates a huge high beta risk because you end up eating massive underutilization charges. But right now, during an AI upcycle, it delivers immense operational leverage. SanDisk is also locking in this advantage, committing $1.2 billion in collaboration payments to Kioxia just to guarantee supply. And they've co-terminated the JV terms all the way out to December 2034. It's really the ultimate asset-light balance sheet protection. Moving on to Section 4, AI demand and global footprint. Let's trace where this demand actually originates. When we look at SanDisk's FY 2026 revenue distribution based on physical shipment destinations, what jumps out immediately is the sheer dominance of Asia, specifically Hong Kong at 25% and the rest of Asia at 23%. You might naturally assume all the AI demand is centered in the US, but the US sits at just 18%. That's because Hong Kong and Taiwan act as the primary ODM integration hubs. All these components get shipped there to be physically integrated into enterprise AI servers before they're deployed globally. Right. And to ensure those Asian ODM hubs keep getting their components without interruption, SanDisk has locked in a staggering $59.8 billion in new business model contract backlog. That number is a total game changer. By legally committing customers to multi-year volume purchases, SanDisk is essentially attempting to structurally stabilize the once super volatile boom and bust memory cycle. Now for Section 5, Hidden Risks and the Balance Sheet. Time to run some critical forensic checks. First up, we have some severe customer concentration. While overall revenue is pretty well diversified, the balance sheet tells a slightly different story. 41% of SanDisk's massive $4.7 billion in accounts receivable is tied up in just 3 unnamed hyperscaler clients. That's nearly $2 billion in cash collections dependent entirely on the operational health of just 3 counterparties. And the forensic metrics definitely don't stop there. 71.8% of their inventory is locked up in raw materials, which is mostly just raw wafers hoarded from the joint venture. Total inventory grew almost 30% year over year. Also, because SanDisk doesn't actually make its own DRAM for SSD controllers, they had to drop $970 million on a strategic equity stake in Nanya Technology just to secure their supply chain. Finally, they're currently enjoying a really nice 12% effective tax rate, largely thanks to Malaysian tax holidays. But those holidays start hitting a cliff and expiring between 2028 and 2031, so that represents some significant hidden future margin pressure. Yeah, and speaking of cliffs, let's talk about the wealth cliff. Since the spinoff back in February 2025, the stock has appreciated an astronomical 4,847%. The unintended consequence of that? Unvested equity awards held by senior leadership have absolutely exploded in value. And these highly appreciated awards are scheduled to vest in concentrated blocks in February and September of 2028. Management explicitly warns this creates a massive governance risk, basically a very high probability of executive retirement or talent attrition once those shares unlock. Which brings us to our final part, Section 6, the HDIN strategic outlook for the next 12 to 36 months. That wealth cliff is definitely a structural risk the board will have to navigate very carefully. But looking forward, we've summarized management's guidance into a 3-horizon growth framework. For Horizon 1, the immediate focus is executing a massive $2.6 billion in capital expenditures for the joint venture in FY27 to upgrade their tooling. Horizon 2, covering the next few years, is all about ramping up physical output at their new Kitakami K2 fabrication facility and, of course, navigating that 2028 retention cliff we just discussed. Finally, Horizon 3 is the long game, commercializing next-generation storage-class memory to bridge the gap between standard NAND and DRAM. These are the 3 critical execution indicators institutional investors will be watching closely. So, the absolutely crucial point we want to leave you with today is this provocative question. Can SanDisk's massive $60 billion AI backlog actually outlast its looming 2028 talent cliff? They have successfully insulated themselves from spot market commodity pricing, but navigating the internal human capital transition will absolutely be their next great test. Now, this analysis was strictly neutral, impartially reporting on the 10K source material, and does not constitute investment advice. If you found this deep dive explainer valuable, you can access the full suite of forensic audits and interactive models powered by the strategic intelligence team at HDIN Research by visiting www.hdinresearch.com. Thanks so much for learning with us today.